Hello and welcome to Princess Dammy's Mind. My name is Princess Dammy. You're watching me on MTM Studio in London. Welcome to my channel. Today I will be teaching my daughter Becky business studies. So this is home study for Becky from me to her. So this is just one way I help my children or my daughter with her studies. So Becky can revise business studies even while walking to school because she could put on a headphone to listen to me rather than listening to secular music. Also, Becky could watch this video on YouTube whilst revising in school or at home if I'm too busy to attend to her. So Becky could also share this video with her school friends who might need help in this subject. So this video has been in series so as to cover all the business studies syllabus for Becky. So Becky will be sitting for a Gcse business studies in May 2020, which is this year. I believe parents are the best teachers. Therefore, I'm teaching my daughter the best way I can. So let's go, Becky. So today's topic is cash flow forecast calculation. So we're going to be talking about cash flow forecast and how to calculate cash flow forecast. Becky, before we start, I will advise you to get yourself a cup of tea with biscuits because this video might take a long time. I'm not sure how long it's going to take, but I want you to be comfortable, have something to drink, get some refreshment so we can start beautifully well. Okay, yes. Now, so today, Becky, you will be learning about how to calculate cash flow inflow, cash inflow, cash outflow, and cash flow forecast. Let me repeat that. Today, I will be teaching you how to calculate cash inflow, cash outflow, and cash flow forecast. Okay? So, and the aim of today's topic is for you to be able to understand the importance of cash flow calculations as part of business planning. Also, you'll be able to calculate this cash inflow, cash outflow, and cash forecast as well. And you will be able to interpret the cash flow forecast. And how to overcome cash flow problems in businesses will be clearer to you as well. So let me recap. Aim of this topic, today's topic, is by the end of this lesson, you should be able to understand the importance of cash flow calculations as part of business planning. Also, you will be able to calculate cash inflow, cash outflow, and cash forecast. I want you to underline the word inflow. You see the word in here means a lot. Let me just underline the in there. Then here, I'm going to underline out. Yes. So the in means inflow, means the money that comes into a company or into a business. And out means the money that goes out of the business. In means the money received by the business. So the money comes into the business. And out means the money that comes out of the business as in payment. The money the business pays out to whoever they're paying the money out to. Like, for instance, if they want to turn their resources into output, then we need staff. So they're going to be paying their staff. Then we need materials to produce whatever product they're producing. Then we need to pay for materials. That is outflow, payment out of the company. So all those things become outflow. But the ones they receive in will be like if they sell a product, somebody will pay them, so the money comes into the company or into the business. So this is inflow. So money comes into the company is called inflow. The one that goes out of the company is called outflow. So outflow is the payment and inflow is the receipt. That is money they receive into the company. Okay, and the forecast is predictions on how much money a business is going to have at the end of each month. For instance, are they going to have enough money to be able to pay every outflow, that is every payment that they need to make within the period? Yes, and then they will be forecasting how much money they are expecting to come in. So when they do that, that is a forecast. They are predicting, they are making predictions on what's going to be coming in and what's going to be going out. Okay, all right. So let me just leave the definition to that minimum interpretation for now. And the next one I want to talk to you about is this. Everything about cash flow relates to all types of businesses. Whatever business you're doing, either you are a sole trader. Remember, I've taught you about sole trader, partnership company, I've not taught you about not for profit company, but I will do that because that's nothing. There's nothing much about that. No, not for profit company organization is only charity organization, but I've taught you sole trader, partnership, and company. Okay, so company is divided into either private limited company or public limited company. But what I'm now saying in essence is that every of these businesses must do cash flow forecast. Whatever they are, they must also do. All of them must do cash flow forecast. They must be able to calculate what money comes, how much money is going to be coming in for them, and how much money they're going to pay out. Cash inflow, cash outflow. So this is why cash flow is very, very, very important for every businesses, and it is a very crucial part of business planning. Okay, all right. Now the next one is the next one, Becky, is sorry. Okay, so the next one is this here, Becky. There are some business terminologies that I need to explain to you before I explain how cash flow is calculated and interpreted. This will help you to understand this topic easily. Okay, so follow me. Let's go. I'm going to make you an example, Becky. I'm going to use a personal example to explain to you what cash flow, cash inflow, cash outflow means, and then the cash flow forecast. Okay, now for instance, Becky, I've drawn up this table for you, and I've put in information here. This is month January and this is month February. Yes, and this is your own personal cash flow forecast. Yeah, all right. So your cash inflows, yeah, for instance, the money that you expect to come in for you as Becky has been yourself, an individual, are this. Number one, you will be expecting money from me, pocket money from mom, say £10 every month. So I've just put £10 in there. Then let's say you are working for Tesco over the weekend. Maybe you work weekend for Tesco as a part-time, just an extra money coming in for you. So the weekend job, they'll pay you like £50 every month. So that is another cash inflow for you. Then your Auntie Jumi gives you £15 every month. That is another cash inflow for you. Then the school, perhaps your school gives you money, because some people get money from school. So let's assume your school gives you money to help you with your transportation, with your oyster, with your transportation or whatever, and they give you £25. Yeah. So definitely that I'm gonna be giving you £10 money from me. You're gonna be working part-time in Tesco, and Tesco's gonna pay you £50 a month, and your Auntie Jumi promise you to be giving you £15 a month, and then the school promises you to be giving you £25 a month. Then all together, when you add all this together, you expect to have £100 coming in for you every month. This £100 that comes in for you, yeah, is called your total cash inflow, which means your total income, the money you're expecting to get every month is £100. So this section called total cash flow inflow, I will call it section A. So I want you to make note of this section A. Yeah, let me just underline it for you there. Section A. Yeah, that's section A of your cash flow forecast. Now let me go to section B. Under section B, then you have cash outflows. That is the money you expect to spend every month or each month. Number one, you want to buy your school uniforms. So £7 for January. And then you're going to buy books and stationery, £10. Then you expect to spend £5 restaurant, going out with a friend, and you want to spend £5 with a friend. Then you want to buy clothing and shoes, £22. When you add all of them together, they come to £44. So these £44 are your expenses, everything you want to pay for in January, and then this falls under your cash outflows. It's called outflows because it comes out of your pocket. Okay, it comes out of your bank account. So you pay this money out to somebody or to some people, and that is why it's called outflow, because it's going out. Therefore, this section is called total cash outflow, section B. I call it section B. Okay, so this total is section B, which is combination of everything you are spending in January. Now, to calculate net cash your net cash flow is I'm gonna call the net cash flow section C. Okay, so it's just gonna be very just gonna be simply section A minus section B. So what you want to do here is to minus how much money you're going to be spending from how much you're going to be receiving. So you're receiving £100. Then when you take away £44 that you've spent, you're going to get £56. The £56 is called net cash flow. Okay, in business term they call it net cash flow. That is, the money remains after you have spent everything from how much you have received. So you've received £100, you spend £44, then you get £56. You have £56 left. So the £56 you have left is the net cash flow. Okay, now whilst you've calculated that, you need to then put into factor some money you have at hand. Maybe in your purse you have £13 left. Before, you have £30, you have like £13, somewhere you kept in your bank account or in your purse that you've not spent. So this money is called opening cash balance. That is the money you had before that was kept somewhere, maybe in your purse, maybe in your bank, or you just reserve somewhere, So let's assume you have £13 in your pocket, or in your purse, or in your bank account. Then you put that money in here. So I'm just assuming you have £13 in your pocket or in your account. So that £13 is called your opening cash balance. That is the money you have before you start getting money from me, from Auntie Jumi, from Tesco, from Bosri. So you had this money for yourself. Okay, so it's £13. So you put that £13 here. Yeah. So when you put that £13 here, you're going to add the £13 plus the how much it remains after you have done all your transactions. Now you've received £100. You've paid out £44 in whatever expenses for all these expenses. You have £56 left. Then you add it to how much you have in your pocket left, because you still have money on you. So this money, £56 plus £13, gives you 69 pounds. Yeah. So £69. When you look at £69 there, yeah, this £69 is how much you have left. So it's called closing bank cash balance. That is, when you have done all your transactions, you've done all your payments, you've received every money you want to receive, the amount that is left now in your hand is £69. Okay, is £69. So this £69, yeah, is called your cash flow forecast. So this is your net cash flow. That is, after you've paid everything, you have £56 left, but you still have some money that you kept somewhere. You had it on there, then you have £69 altogether at the end of January. So what we're going to do now is how this one is being calculated. Then the next month, because cash flow forecast is not just for 1 month, it's the prediction for a month or for a year. Some do it for like up to 3 years, some do it for like up to 5 years. But when they do that, it's subject to review every month, because they can't just do it and then leave it there for forever, So they need to be reviewing it as they go along in their businesses, as things are happening, because things changes in business all the time. So they need to keep on changing and reviewing the cash flow forecast. So for this month now, January, you've got £69 left, which means you are able to pay everything that you wanted to buy, and then you have something left. So you have positive left. This one is positive because you have £69 left in your bank account right now, which is okay. Now, but for the next month, you need to project next month as well. So what we have now is, for next month, see this closing bank cash balance is going to become your opening. It's going to become your opening bank cash balance for next month, February. So you're gonna put this £69 here, £69, because that is how much you have now in your account for January. So it's gonna be your opening. That is the amount you have left in your account or in your purse for next month, because you've got it. Now come next month. Now let's assume that next month, February, I decided to give you £5 instead of £10. Then you put the £5 in there, and Tesco's still gonna pay you £50 because you're working for them. Then your auntie Jumi too decided to give you £8 this month because she hasn't got enough money, and the school bursary still gives you £25. And then when you add all of this together, you're gonna get, so let's do the calculation. You're gonna get £5, yes, plus £50 plus £8 plus £25. So that gives you £88. So it means that for this month you're getting less money, less income compared to January. Okay, all right. Now that is your cash inflow. That is how much you're getting in February. Now come down to the cash outflows. Now you're not going to be buying school uniform this month for whatever reason, so I put 0 in there. But for books and stationery, you want to buy £50 worth of books because your school asks you to buy more books. And then for restaurants, you're going out with your friends because one of them is doing birthday, so you're going to be spending maybe £20 more this month. And then for your clothing, you decided you want to buy top coat and everything, so you're spending £60 there. And then when you add all of these together, yes, which is going to become your total cash outflow. Let's see what that comes to. Bringing this calculator to you now. Yeah, I hope you can see this calculator here. So if you say 50 plus 60 for plus 20 plus 60, let's say how much you get. So 50 plus 20 plus 60, that gives you 130. So you're going to be spending £130 in February, and that becomes your total outflow, okay, which is your section B. So as you can see, you're spending more in February than in January. Now we need to now find out how much money you're going to be having left in February. So your net cash flow, which is section C, is going to be A plus B. That is section A, which is £88, plus section B, minus section B, which is 130. So let me bring the calculator back to you again. Yeah. So we're gonna do. So it's gonna be £88. Yep. Let's do the calculation now. £88 minus £130. So you get minus 42, which means minus 42. Minus 42. Yes, which means for this month, can you see you got minus 42 there? Yeah, which means you're spending more. You're going to be spending more than you're receiving. Yes, which is not very good. Okay, now let's see now, because remember you've got your opening balance here, which is £69. So what you want to do now is to calculate your closing balance at the end of February. So, and your closing balance, which is section E, is going to be D plus C. That is to say 42 minus 42 plus 69. Okay, so you get £27 left. So you're still making you're still making you're still okay for the month because you still have some money left, which is your closing balance, your closing bank balance for February. Okay, I'm gonna change the figure around. Yes, now let's assume that here you're gonna be spending £100 for your books. Yes, so which means your total cash outflow will be different now. Okay, so and then the net flow will be different. Just want to use different analysis. Now let's do the calculation. I've just changed the figure. Yeah, now £100 plus 20, that's how much you're spending, plus 60. So you decide to spend £180. So now it's gonna be £180 you're spending. So you want to spend £180 in February. Okay, so if we calculate your net cash flow, which is going to be A minus B, that is £88 minus 180, what do we get? £88 minus 180 equals minus 92. That is, which means, what this means is that you're spending more than you're receiving. So you're only receiving £88, but you're spending 180. So you're going beyond what you have in your account. But what happened now is already for that month in your bank account, you have your closing balance, which becomes your opening balance for February, which is £69. So £69 now, what we're going to do now to get your closing balance will be, we're gonna do this, which is £69, yeah, plus minus 60 minus 92. So let's see what we get. So we're gonna get minus 92 plus 69. So we get minus 23. So as you can see, you are spending more. So your cash flow is saying that you're not going to have enough money to be able to buy all of these things, all of these items in February. You're not going to be able to buy all of these items in February. So this is the importance of cash flow. It tells you how much money you're going to have left, how much money you have in your account, and what you can buy and what you cannot buy. And having given you this information is very important for you to now decide what to do with the expenses in February, because you're not going to have enough money to buy all of these things. This is where business start to make decisions on maybe now they need to reduce something or they need to increase their income one way or the other, So anyway, I'm gonna put this now on I'm gonna show you the same thing on what's it called now, on Excel, because this month, January, February, is not just the January, February you want to do. You have to do all these projections till like December, 12 months every year, 1 year, 2 years, 3 years. So you're gonna have to do this calculation for the rest of the month, doing these projections. But for these examples, you can see that in January you have enough money left, which is £69. In February you don't have enough. So this is why cash flow forecast is very, very important. All right. What I want to do now, we're going to apply the same principles that we've applied to your own personal account to how business calculates this cash flow forecast. Okay, so I'm going to give you a scenario here, which is this one here. I've already written everything down for you. Peter and Sue are into partnership business. Below are the details of the business intended outgoings, that is the cash outflows, and income, that is the cash inflows. Anywhere you see cash, when you say outgoings, outgoing means expenses, what they're going to be spending money on, which means cash outflows. Okay, when you say income means cash inflow, that is the money that is coming into the business. So this is a scenario. So they have cash at bank, which is £1,000. So that cash at bank means the opening balance, like you had your own opening balance here. You had £13 when you're starting, yeah. So the same way, Sue and Peter have £1,000 in the bank account. Then they have savings, £500. They have bank loan, £750, and then they're going to be selling £380 worth of goods. And then they're going to be buying stock for £800 and pay off the staff £400, and office rental for £500, and electricity for $200. So based on this information, we're going to calculate cash flow forecast for Peter and Sue's partnership business. Okay, when you see a question like this, the first thing you must do is to categorize the information you were given by identifying which one falls into cash inflow category, which one falls into cash outflow category, and which one falls into opening bank cash. These are the three categories you must understand and master before you could tabulate the information correctly. So therefore, the categories will be A, B, and D. So let me show you again. Category A, B, and D. D is the opening balance, the amount left they have before they started the business. Okay, so A, B, and D. A means the cash inflow category, cash outflow category, and then the opening balance, what they have in the account, which is the D. Okay, once you know this information, then you are good to go. Yes, so now we're going to categorize A, B, and D for the information given about Sue and Peter. Okay, so A, like I said, is A category is cash inflow, B is cash outflow, and the D is the opening bank cash balance, which is the amount they have in their purse or in their account before they started the business. So once you understand what falls into these three categories, you are good to go and tabulate the information. So from the scenario given, let's categorize the information provided. Now, so this table that I show you here, I'm now going to categorize it. Yeah, because I've already done it for you. So now in the category, the cash at bank, which is the £1,000, will fall into category D, which is the opening cash bank balance. Like you have your own pocket money, the money you will reserve in your purse, they too have £1,000 they reserve in their purse, okay, or in their bank account. Then they have savings, which is category A, the inflow. They have bank loan, which is category A, cash inflow. Then they have sales, category A, cash inflow. Anything that's category A falls into cash inflow. Anything that's category B falls into cash outflow. So stock purchase, when they purchase something, that means they buy something, so that means they're spending. That falls into category B, which is cash outflow. Then they pay wages to the staff, that falls into category B, cash outflow. And then they pay the rent for the office or for the business, whatever they maybe they pay the office rental, yeah, which is category B, and that is the cash outflow as well. And they pay for the electricity they use, and that falls into category B, which is the cash outflow, because all of this falls into cash outflow because they are spending. It's an expense. And all of these four items fall into category A because they are receiving something. They are receiving money. You know, they're not spending them, they are receiving. So they are cash inflow. So now, based on this information, we're going to tabulate the cash flow forecast for January and for February. And note here in the instruction here, it says the figures remain the same in February 2020, except that there was no stock purchase in February. So when we come to calculate the February, we have to take into account the fact that they did not buy any stock in February. Okay, so let's see how we can tabulate it. Let's just go there. Okay, I'm just gonna quickly scribble this down. So we have cash at bank, 1,000, then savings 500, bank loan 750, sales 380. Okay, and then they have stock purchase £800, and wages to staff, wages £400, office rental £500, and electricity £200. Okay, now let's go into this. So we're going to categorize now. So what are the cash inflows, which is the category A? Number one, we have they have savings. So we're gonna put down here savings. They have savings that comes to savings of, is it's a 520. Let me just check the savings again. They have savings of £500 savings. Okay, £500 savings. Yeah. Okay, and then they have bank loan. They have bank loan for 750 bank loan. Then they have sales. So they sold items. All the sales comes to 380. So now, if we want to calculate the cash, let me put the calculator here for you to see. Okay, now we're going to do calculations of these three items that they received. Yeah, so they have savings of £500 plus 750 bank loan. The bank gave them loan, and then they sold something for 380. So everything came to 1630. That is 1,600. And so now we're gonna put the 1,630 there. So that is the total cash inflow for that. This is the whole amount that they received in January. Now we're gonna calculate the cash outflows. Yeah. So they bought stock purchase. So stock is materials or whatever they want to use for the production or for whatever they're doing in the business, and they bought that for £800. And then we have the paid wages to staff. So they pay staff salary, wages to staff, and then that is £400 they paid them in January. And then they paid for office rental, which is another £500, and then they paid for electricity as well, which is £200. So we're gonna calculate all of that now and see what we get. So £800 plus 400 plus 500 plus 200, that gives us £1,900. So we're gonna put it here, 1,900, sorry, £1,900. Okay, so the £1,900 becomes the net, sorry, what did I put it there? Sorry, I'm supposed to put it here. So 1,900 is the cash outflow. Okay, now we're going to calculate the net cash flow, which is going to be section A minus section B. That is cash inflow minus cash outflow. Okay, so now here we need to calculate net cash flow, which is going to be 1630 minus 1900. So you can see the net cash flow is 270 minus 270. That means they're going to be spending more than they're going to be receiving. You can see they only receive 1,630, but they're going to be spending 1,900. Okay, now, but now we need to calculate the next section, which is the opening bank cash balance. Remember, the scenario says they have cash at bank for £1,000. Put the £1,000 there. Yeah, see now they got £1,000 here. Yeah, all right. Now, so now because they got £1,000 here, now we're gonna have to now calculate the closing bank cash balance, which is gonna be D, because the opening bank cash balance is section D. It's gonna be section D plus section C. Okay, so now this is the C, net cash flow. Yeah, So it's gonna be D, which is £1,000 plus minus 270. So let's do the calculation to see how much we get. So £1,000 minus 270. Sorry, I think so this is it. They have minus 270 plus 1,000. Okay, so we get 730. So we got 730 here. So because they have opening cash balance of £1,000, yeah, they're able to break even. They're able to have enough money for this month. Otherwise, if they didn't have this £1,000, they will be struggling with net cash flow, with the cash flow. Okay, so but because they have this £1,000, that means they're good to go to pay for everything in January. Okay, now we're going to apply the same scenario for February as usual. So in February, everything remains the same except for the fact that they did not have any stock purchase. So when it comes to this stock purchase, we put 0 in there, okay, but everything else remains the same. So let's see now. The savings is £500, the bank loan is 750 still, the sales is 380, for instance, 380. When you calculate everything, they still have 1630 because nothing changes in February. Okay, so that is it. But for cash outflow, what changed there is the fact that they did not buy any stock purchase, so we put 0 in there, but everything else remains the same. So they still pay £400 for wages, £500 for rental, and then they still pay £200 for electricity. And when you add these 3 items together, we have, let me bring the calculator here for you, we have £400 plus £500 plus £200. That is 1,100. So they are spending 1,100 in February, which is less than what they were spending in January if you look at the 2 figures. But now we're going to have to calculate the net cash flow. So the net cash flow is section A, which is cash inflow minus cash outflow. So now let me bring the calculator back here. So it's going to be 1,630 minus 1100. So they're going to get 530. So we put it 530 here for the net cash flow. That is the 530 that is left. Okay, looks like they're doing well in February. But opening cash bank balance here now will become the 730 because the closing bank balance for January becomes the opening bank balance for February. So this is the amount they have left in the account in January. So that account, which is called this amount, which is called the closing bank cash balance for January, will become the opening bank balance for February. So we put the 730 in there. Okay, so now that, because that's how much they had left in January, so it's still in the account, so you put that one there. So now to calculate how much they have left now at the end of February, so you're gonna do D plus C. So D is the opening balance, which is the 730 plus the net cash flow. Okay, so now let's do the calculation again. So that will be D plus C. So the D is 730 plus the net cash flow, which is the C, which is 530 plus 530. So they have 1,260 pounds left in the account for February. So now for March now, this closing bank balance will become the opening bank cash balance for March. Okay, so that is how they calculate. So you keep doing this until they get to the end of the month. Okay, I'm going to show you now. I'm going to put all of this in Excel for you to see. Okay, so as you can see, just roughly right like this, in January they had 730 left, although they didn't have enough money to do everything, but because they had the opening bank balance of 1,000, they were able to pay for everything. So same as in February, they were good to go, they were able to pay for everything. But in some months, they might not be able to pay for everything if they have less money coming in. Okay, now I'm gonna go into, let me see if I can actually copy this into Excel. I want to put this one here somewhere. Okay, now, sorry, I want to show you, I want to do this calculation on Excel for you so that you will be able to see. Okay. Okay, Becky, so what I want to do is to actually show you how everything looks for the rest of the year using Excel. Okay, so the same figure now we're gonna put in here. Yeah, so they had savings in January, savings, I'm just gonna repeat myself, for £500, and they had bank loan for 750, and they had sales coming in for 380. So when they add everything together, yes, they had 1,600, and they had 1,600, 1,630. Okay, I want to actually put the okay, all right, that's what I want to do now. So the total cash flow is 1,600, like I said earlier on. So now for the outflows, they have stock purchase, yeah, for £800, and they had wages, they paid to staff, wages to staff, which is £400, and they had office rental, which is £500, and they had electricity payment, which is £200. Okay, so now the total cash outflow is 1,900. Okay, now we said we need to calculate the net cash outflow. Okay, so the net cash outflow will be A plus A minus B, that is cash inflow minus cash outflow. So I'm gonna just put calculation there, minus B. So 270 there. Okay, just like we had before. Now the opening cash balance, yes, we said it was £1,000 because they have £1,000 in the account, and then we now need to calculate the closing bank and the cash balance, which is D plus C. Okay, which is gonna be D plus C, this one plus that 730. So they have 730. As you can see, the 730 automatically is in the bank for February. Let me just show you. This is February account now. This is February. Okay, this is February line. So this money 730, they need to bring it up to it's going to become the opening cash balance in February, because that is what is left in the account in January. So they bring it forward in February. Okay, so they put it automatically. So when you're doing your calculation, you have to automatically just put this one there. You transfer this one and put it over there. Okay, because that is the amount left. It's just like you have money left in your account before you start doing anything. So the money is there, so just bring it forward and say, okay, that's the money we have in February from what we have left in January. So now in February, they need to now do the same thing. In February, what did we say they do in February now? Everything remains the same in February except that they did not pay for stock. All right, so we're just gonna put everything there. So everything remains the same. Copy. No. Sorry. Okay. So everything, what I want to copy is this one here. Yeah. This one here. Copy this one. Oh my God. Sorry. Okay. I'm going to take this away now. It's coming in between my stuff. Okay. Okay. I just want to copy this here. Let me see if I'm going to get it now. Uh-oh. Okay, I'm just gonna put in manually. Yeah, £500 there, 750 down here, and 380 down here. Then I get the same. So here I'm gonna get 1630. Yeah, and then for February there's no stock, so every other thing remains the same. So we put it in there. Then £200 there. Yeah. So when we do the calculation, yeah, so now we're gonna now add all this together. So the 1000 there, and then for the net cash flow, yeah, we do the same calculation. So we do the same calculation here, which is A minus B. Yes, which is A minus B. A, I'm just putting formula in there, minus B, which is that. So we get 530 there. Then here is gonna be the same as that. So we're gonna find out how much we have left, so which is gonna be D plus C. Okay, so we put calculation there. Okay, so we get 1260. Okay, now because as you can see, the closing cash balance for February has now become the opening cash balance for March automatically, because I put the calculation, I put the formula there already. Okay, so that can just give me the opening balance. But if you're doing it, you have to be the one to put this number in for yourself. But because I'm using computer, I've asked the computer to copy the closing balance into the opening balance for me. Okay, but if you are doing the calculation, you have to be the one to put this figure in from here to there, because your closing balance for February becomes your opening cash balance for March. Okay, now, so let's try and put in some figures for the rest of the month. Yeah, I'm just gonna make this up. Let's say now they make the savings is 300, and then the bank loan is nothing here, and the sales figure is 100. Okay, so let's see what we get. Okay, and for stock purchase, let's say they buy something in March. There's a 20 stock, wages 800 wages, and then office rental 600, and then the paid electricity 120. Okay, let's see what they're gonna get for the cash outflow. So for the cash outflow, so for the cash outflow is 1540. Okay, now for the net for the net cash flow, yeah, is 90. Then okay, so this is what they get. So the closing balance is 1350. All right then. So let me put more figures for April. April, they add So April, let's say no savings, no bank loan, and sales is 100, or let me say sales is 150. Okay, all right. So the net cash flow is sorry, I think I made mistake here. The net cash flow here for March should be this item here, 400, and for this one it's okay, so 400 here, which means they're not making enough money in March. They have less money, but so therefore, but they're still able to break through because they had some money left in the account. Okay, but as you can see in March they were making a loss, but because they had opening cash balance in their purse, in their account, they were able to pay off for everything. Okay, so they will be using perhaps their savings to pay off. Okay, now let's do April. Okay, so April they have this. All right, and then they purchase something for £800, and they pay £2,000 for wages. Maybe they had more staffing that month, and the rental is goes down for whatever reason, £300, and electricity they pay £500. So when we put all these together, comes to 3,006. And then for the net cash flow, yeah, so net cash flow, so there is A minus B, yes, which is 150 minus this. So they're making a loss there as well, but they have this. So let's calculate what the closing balance is gonna be. So now they're making real loss here. You can see it's minus 330. Okay, so they had nothing left in the account. They're making a loss here. So for this month, no, it's a big issue for them. Okay, so they're gonna carry on like that. So I'm just gonna put figures in, copy. For the rest of the year, I don't want to waste your time. I'm just gonna put in figures in so that it will automatically calculate itself. £500, £200, £900, and then sorry. Okay, now I'm gonna put figure in here as well. £900, 50, 560 there, 74 there, 300 there. So let's see what we have. So we're gonna do this for the rest of the year, for the rest of the month until the end of the year. They have that. So copy. All right. All right. So now for June, sorry, I'll put June, July together. June, and this will be July. June. So June now we have 500, 200, then 100 coming in, and then so they have £800 there. Then they have 200, 150, and 25 there to pay. 370. Yeah. So because I've already put formula in those things for me, that's why I'm able to do all of this. Okay. All right. So I'm going to do it to the rest of the year. So bear with me. 200, 100, because we need to change the figures because they will be doing different things, different activities for each month. So they'll be coming up with different kind of cash flow forecast for each month. All right. So this is how companies do their cash flow forecast. So because I'd already put figures in here to calculate it for me automatically, but it's the same way if you are calculating them manually as well. 800, 799, 752, and then here we have 500, 8196, then calculate it for me automatically. You can see the business is not making a lot of money now. It's beginning to make losses as we go along. Okay. Now, £8,000. Sorry, I shouldn't have anything there. Yeah. All right. So here for the outflows, they have 4,200, 300 there, and then 74. Yep. Okay. I want to put I want to mark this green because I want to talk about it. Is it green? Yeah, I want to mark it green and make it bold so I can. Now here, let's say they now make £90,000 there, and then and here 500, 200, 780, 1,000. Okay, 1,000 there. Okay, they're making money there. Good. Okay, here I want to make 20,000 there, 1,000 there, 3,000 there, 1,000 there. Sorry, 2,000 there, 3,000 there. For okay. Okay, they're making profit there. Now one last one, which is December. £15,000 there, 20,000, 2,000 there, 200,000 there, 400, 5,000, 800, 60, 9,000. Now this is it now. So what I'm going to do, I'm just going to highlight the minus figures in red. Yes, I'm going to put them in red. Anything that says minus, I'm putting them in red. Red means it's negative, means the business is going to be struggling with cash in this month. The ones that are in red means the cash flow for this month are going to be okay, let me go up now. So now this is January to December. Yeah, we done January to December. This is what cash flow forecast for a year looks like. Okay, so this is what cash flow forecast for a year looks like. So the company will come up with this kind of projection. This is what is called cash flow forecast. So for each month, they will be able to see when they will be struggling with money and when they will not. Like in January, everything looks okay. February, everything looks okay because they're making profits. They will be able to. They're gonna be able to have enough cash in those in those months that have plus. Okay, where there's minus figures, that means they're not gonna have enough money. Okay, for these months. So this is the importance of cash flow forecast. It allows the business to know when the money is gonna be hard for them, and then when they're going to be having enough money. So they'll be able to plan to say, okay, what are they going to do when they're not going to have enough money? Are they going to reduce their cash outflow, the activities for cash outflow? Maybe if they buy stock for like in this month now, they want to buy stock for £200 and they want to pay wages for this. So they might think about, okay, what can we reduce? Or how could they actually increase how much that will be coming in for them? Okay, because as you can see in this month they have £1,600 coming in for them, yeah, but they want to spend 1,800, which is a lot more, and then same as other months as well. So this is what cash flow forecast is. This is what it looks like in real life. And some companies, some business will do this for over 3 years. They do year 1, year 2, year 3. But the important thing is, as they move along in operation, in business operation, they need to be reviewing this cash flow every month to make sure that they have enough money to pay the staff, to pay for the materials, to pay for their rental, to pay for utility bills as well. Okay? All right. So Becky, now that I've shown you how to calculate cash inflow, cash outflow, and the cash forecast, okay, I'm gonna now teach you the how to interpret all those figures. Now we've come up with the this is for Peter and Sue. We've done this for Peter and Sue for January and February, remember? Now we're going to interpret what these figures mean to them, okay? So now the question you want to ask yourself is this: why do I need to interpret the cash flow forecast figures? So the answer is, number one, the business needs to know if it has got enough cash to operate its business when it needs the money. So cash flow is about time. That is the time the money is needed. So it's not just a question of, okay, I'm going to have money in December, but you need the money in January. So you must have enough money in January to do whatever you want to do in January, regardless of if you're going to have more than necessary in December. But if you don't have enough now in January, then the business is going to be suffering, because the business can't wait till December for you to have whatever money you're going to be having to do the business. So it's about timing. So cash flow forecast is about timing. The money you need now to buy all the materials you need for the business, to pay for the staff, to pay for any utility bills and whatever they need to pay for. So cash flow is about timing. It's about time. So having enough money at the time that the business needs the money. That is why it is important to have cash flow forecast and then be able to interpret the figures. For each month, you need to see if the business has either a negative cash flow or a positive cash flow. Like I showed you in the Excel paper, you can see some of them have negative cash flow, some as positive cash flow. The ones that has negative means that you will be this means that the ones that has negative means that the business hasn't got enough money, okay? And when there is positive, that means the business has enough money to pay for whatever it wants to pay for. So for each month, you need to see if the business has either a negative cash flow or a positive cash flow. This means you will be interpreting the closing cash balance category D figure. Let me show you again. Category D figure is what you will be analyzing, which is the D and the E here, yeah. So for instance, now you need to talk about the C. Number one is not having enough money for the net cash flow, but for instance, it's got enough opening balance to pay for whatever, and then at the end of the day, so you'll be interpreting the E section of the cash flow. Okay, so if figure has a negative sign, like I said earlier on, it means the business is in cash flow crisis for that month. What that means is that the amount of money that will come into the business that month is not going to be enough to pay for all the business expenses, which is cash outflows. Okay, expenses means cash outflows, like I've been telling you all along. Then if the closing cash balance shows a positive figure, that is 550 in this example, that means there's enough cash to pay for the business operation. I said in the example 520, e.g. 520. Where did I get that 520 from? Is it from you? No. Okay. Okay. Now, so I think that 520 I put there is not let me see. Okay. So e.g. so figure D. So if the figure has a negative sign, e.g. if it says, okay, I'm just making an example here, okay, it doesn't reflect the actual figures on the stuff that I made. Okay, let's see now. Okay, if the cash flow is having, let me see. So figure D. So if the figure has a negative sign, e.g. minus 520, so let me see what we have for real in our calculation for figure D. For D, we have £1,000, so we're not making any loss there. Okay. All right. So let's stick to just the example. If the figure has a negative sign, or for example, minus 520, it means the business is in cash flow crisis for that month. What that means is that the amount of money that would come into the business that month is not going to be enough to pay all the business expenses. So if the closing cash balance shows a positive figure, say for example 520, okay, if it shows 520, that means there's going to be enough money to pay for the business operation. So for example, now in your real calculation, the closing cash balance shows 730. That means the business is going to have enough money to pay for everything. Same as in February, they're going to have enough money to pay for everything. Okay, but in the other Excel that I showed you for the remaining months, some of them are showing negative closing cash balance, which means the company will not have enough money to buy to do its business. Okay, let me see if I can get it somewhere here. So as you can see on the spreadsheet I showed you earlier on, the closing cash balance on the red ones are showing minus. When it shows minus like this, it's negative, which means they don't have enough money. When it shows positive signs like this, that means they have enough money for that month to buy or to do whatever they want to do in the company. Okay, now so that's analysis about that one. Now I'm going to now let's interpret Peter and Sue's cash flow forecast. So interpretation is closing cash balance for January for Peter. Yeah, closing bank balance for is 730. Okay, 730. So let's put the 730 here. So this is 730. So put the 730 there. So now we're going to have to explain the closing cash balance. Is what it is by looking at the explain why the closing cash balance is what it is by looking at details in cash inflow and cash outflow. You can see they're making they have enough cash here for January, so you need to explain why they have enough cash for January. So let's go back into the table here. So now they have enough cash, 730 for February. So why do they have that? The only reason why they have that is because they have the opening cash balance of 1,000. They have money reserved before for £1,000. Otherwise they will be making a loss, because if you look at how much they have coming in is 1,630, which is the cash inflow, and they spent more than they had. Ordinarily, now they didn't have enough money to pay this, but because they have the reserve of £1,000, that's why they're able to have the 730 pounds cash flow forecast. Otherwise, they will be struggling. So you need to be able to interpret this analysis. Look at what the inflow says, look at what the cash inflow says, and look at where the money is coming from. So the money for them to offset this negative balance is the £1,000 there. Okay, so now so you're gonna have to explain that when you put the figures in there. So the closing cash balance for February is what? So let's find that. So closing cash balance for February is 1260. So let's put it in there. 1260. So we put in there 1260. So that is how much cash forecast they have in February. And again, you have to explain why the closing cash balance is what it is by looking at the details in cash inflow and cash outflow. So let's look at why they have this balance in February. We're going to go back into the table. So now it is this table in February. Yeah, why did they have this? Number one, in section A, the cash inflow is 1,630, and then the cash outflow B is 1,100. So as you can see, they have enough money coming in for them in February, because the amount they have is more than amount they're spending. So the net cash flow is 530. Okay, they don't have any negative cash flow here, which is good. And at the same time, they have closing balance of 730, or the opening balance of 730, which is from the closing balance from January, so which is brought down up here. So when they add the two together, it comes to 1,260. Okay, so we're getting there. All right, so for each month of the cash flow forecast, you must explain what is going on with the business in regards to cash, and that is just how you need to explain it. You don't have to explain it more than that, you know. And finally, you may have to advise or suggest what the business will do. We need to do if the figure is negative. That is, if they are in cash flow crisis. If there is going to be cash crisis, the business owners may decide not to carry out the operations, or they may look for ways to solve the cash crisis problem, maybe by applying for bank loan or reduce cost of operation. So for instance, now where they're making loss, if they're making loss, for instance, now, even though that they have enough money here, then they will be struggling. So let's assume they don't have enough money here, yeah, and then they are struggling with cash flow. Then you can advise them and say, okay, because you're spending more on so they might have to reduce the stock they're buying, they might need to reduce something here, blah blah blah, you know. So it depends on what the business is doing, and then you'll be able to give advice on the way forward. So now let's talk about the benefits of having a positive cash flow forecast. Like I said, it's always good to have the positive one, but there's a reason why it is very, very important that they do so. So the benefit of positive cash flow forecast are this: the business does not need to borrow money to operate the business, because this is it. When they have more money in the company, they're able to pay for all their expenses, and they have enough money coming in. They will not need to go to the bank to borrow any money. Okay. And by not going to the bank to borrow money, they will be avoiding back interest rate, because when a company borrows money from the bank, yes, the bank will charge them an extra money, which is called bank interest. Yeah, they will charge them interest on the loan. So for instance, now if they borrow £100 from the bank may charge them an extra £10 on the £100, which means they will pay back 110 to the bank. But in this instance, when they have positive cash flow forecast, they don't have to borrow money. Therefore, they are saving money by not paying interest. Paying interest or incurring debt, the business will increase its profit as well. So when they don't have to pay more money to the bank for anything, they will be making more profit, because it is from the profit that they will be paying out their expenses there and there. And if they don't have any money to pay back to anybody, then the money remains in the company. So in that case, they will be making more money. Okay, if the business decides to borrow money from the bank or elsewhere, the lender, which is the bank, will have confidence in them and will be happy to lend to them because they know the business can afford to pay back the loan. This is another reason why it's good to have a positive cash flow forecast, because when they do have positive cash flow forecast, that is, they are able to manage their business well and everything, they have money coming in to pay for expenses. When they eventually want to go to the bank, let's say they want to expand the business and they now go to the bank to borrow money, the bank will be happy to sort of like loan them the money, because the bank will have the confidence in the business because they are already managing the cash flow properly. Okay, then the third reason why it is good to have positive cash flow is because the business has reduced chance of failing or close down. Because when it shows that the cash flow is looking positive, it means the business has a reduced chance of failing or closing down because they have enough money to the operation, so they're not going to close down. So these are the major reasons why it is very good for a company or a business to have positive cash flow forecast. And as you can see, these are the reasons why cash flow forecast is very, very essential for every business, for every company. Okay, so people cannot avoid it. No business can avoid it, and it's very, very crucial. A business cannot operate without cash flow forecast. They need to know. They wouldn't hire people and then come to the end of the month when they're meant to pay salary and tell the staff and say, oh, I'm sorry, we don't have enough money to pay your salary, just go home. Who does that? No one does that. But when they do cash flow forecast, it will be able to tell them if they're going to have enough money to pay for the staff or not to pay for the staff. Okay, then they can make up their mind and say, okay, we can't have staff this month. We need to maybe take part-time staff to do certain things, or maybe we're gonna just take maybe 1 or 2 staff or 3 staff, as we can afford, rather than taking 10 staff. Okay, so cash flow forecast is an information. It gives financial information to businesses for them to understand if they have enough money to operate the business. So Becky, the keywords or key terms for today is cash inflow, cash outflow, cash flow forecast, cash flow crisis. Okay, so and these are the terms we use all day today. All right, and earlier on I think I did something for you which I can't find now, which is just the formula. Can I find it now? Okay, I gave you the formula for cash flow. Okay, I think I'm going to give it to you right now. The formula for cash flow. Okay, I'm gonna put it somewhere here. Okay, I'm just gonna I'm gonna put it somewhere here. I'm gonna put it somewhere here. Okay, I'm gonna put it somewhere here. I think I've already done it. Okay, I've already done it. Only that I skipped this slide. I didn't no. Okay. Okay. Now let me just recap. Okay, as in summary, sources of Becky's money. I'm using you as an example again now. So Becky's cash flow forecast. Your sources for money is pocket money from mom, weekend job in Tesco, money gift from Auntie Jumi, school bursary. Yeah, when you add them all together, they give you the cash flow. Okay. Then so that's how you get your cash flow. Then for the cash outflow, which is how Becky spends her money, yeah, your expenses, your school uniform, plus your books and stationery that you bought, the money for restaurant, and plus clothing and shoes that you bought. So if you add everything together, that comes your cash outflow. Okay, now business does the same thing. Okay, business have cash flow and cash inflow and cash outflow, just like I've been explaining to you. And I gave you, and I'm going to give you now, the formula to calculate cash flow. This is it. So formula to calculate cash flow forecast is this: cash inflow minus cash outflow equals net cash flow. Therefore, the net cash flow plus opening cash balance equals closing cash balance, that is cash flow forecast. So like everything I've been telling you earlier on, so the cash flow for inflow will be the section A, like I showed you earlier on, section A, minus cash outflow, which is section B, okay, and that gives you section C, cash flow the net cash flow, which is section C. Okay, sorry, section C. Okay, now, so therefore your section C, which is net cash flow. So C now, yeah, sorry, why is it doing C now plus your opening cash balance, which is the D, which is the money kept in your in your purse, excuse me. Yeah, we give you closing cash balance, which is your section D. Okay, so when you look at everything I've written here, is the same thing as what we've been talking about. Yeah, it's the same thing as we have been talking about all day today. Okay, so this is just the simple formula to it. As long as you understand what category you have to put into cash inflow and then cash outflow, then all this calculation becomes so easy for you. Okay, so this is it: cash inflow, cash outflow. Okay, net cash flow is your section C, and your section D is the money you have your purse already, which is the opening cash balance, and the closing bank cash is the section E. So let me go back. See, cash inflow minus cash outflow equals net cash flow. When you know this formula, then you're ready to go. You're ready to do cash flow forecast, and you just tabulate your table and put it in different months, and then start putting figures in, and that is all about cash flow. Okay, Becky, so that's all for today. Okay, so for the next video, I will be teaching you how to calculate cost, sales, profit, and break-even analysis. So get prepared, and if you have time, you might need to read these topics before I come on board to teach you these topics on cost, sales, profit, break-even analysis, as you will be sitting for your quantitative exams pretty soon in business studies. And please do let me know if you are struggling to understand any aspect of this session before the next lesson, and talk to me at home or send me an email from school when you are revising. Okay, and make sure that you study hard. Okay, and bye for now, Becky. I need to go now. This is your mommy. I love you so much. Take care of yourself and make sure you study very well. Okay, bye for now. Love you. Bye.